Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
Hi, everyone. Welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm joined by Fred Moskowitz. And so Fred's a note investor. He's an entrepreneur. He's a public speaker. He's trained a number of investors from all different walks of life on, and helping them to create passive income streams on their own. He's also a fund manager. So he manages a mortgage note investment fund and is really an authority and industry veteran within the note business. He's an advocate for spreading awareness about self-directed IRA investing and enjoys teaching investors, how to really accelerate their financial growth using their self-directed accounts, such as, their self-directed IRAs and even self-directed health savings accounts and other vehicles. So Fred, how you doing this morning?
Doing fantastic. Thank you, Dan, for hosting me on your show today. It's a pleasure.
Yeah, of course. No, thanks for coming on. I know we met a couple years ago at Note Expo, so it's good to to chat again and have you on. So maybe we can start by you can tell us a little bit about some of your background in notes and how you got started.
Yeah, absolutely. I got started in note investing about 10 years ago. And the way I learned about it was I was at that time actively involved in real estate investing, and I happened to be attending a real estate seminar that was about negotiating, and it was being presented by Jimmy Napier, who, if you're probably familiar with Jimmy Napier, he is someone that I consider the grandfather of note investing. That he started with this probably in the 1970s, and he wrote an excellent book called Invest in Debt. In any event, he was teaching a class on negotiation for real estate investors. That was the audience. And as often happens when you attend these type of trainings and seminars, sometimes the most valuable golden nuggets come from when the instructor gets off topic and goes on side discussions. And he started talking a little bit about note investing, and what he said, I will never forget this. He said that real estate in general is a great avenue to build capital when you're first starting out. But if you are able to take that capital that you've built in real estate and then redeploy that by investing into debt instruments, you can really skyrocket your rate of return. Mm-hmm. And that little statement stuck in my mind, and right at the end of that seminar, I went and bought his book, Invest in Debt, and took it home with me. I said, I need to look into this. And that really started my whole journey in this business. So it's been a fantastic experience learning along the way, and it's really, I found that there's a very tight-knit community of note investors throughout the country, and over the years, everyone gets to know each other and do business with each other on an ongoing basis.
Yeah, it's definitely a very small industry. I'm jealous that you were able to find it 10 years ago. I wish I had found it that long ago. So it sounds like you probably got more of the benefit of the flood of notes that hit the market after the financial crisis.
Yes. That was definitely the environment in which I started in, was around that time. And I've watched things evolve and change over the past 10 years drastically. But it's good for note investors to be able to be nimble and flexible and adapt to changing market conditions. And if you're able to weather that, that's what gives you longevity in this business. Because as you know, we see a lot of people get involved in note investing and then they hit some difficulties and challenges and then totally exit the space.
Yeah, I've seen that a lot just in my few years in the business where, yeah, sometimes people come and go fairly quickly, but then there are other ones that hang around for years and years. Yeah. So what's been your primary focus lately? Now that we're in this kind of different environment, this maybe a little tighter.
Yeah, my primary focus has been a change in direction, and certainly looking for note acquisitions at a higher level, doing larger transactions, and um, also adding an educational component. I've had so many people approaching me asking to learn from me, asking to work with me, and I've been doing quite a bit of speaking and teaching and education as well. I found that very rewarding. And what I find is a lot of the people that I encounter, we end up doing business together in some form at a future date. So it helps with building relationships with people and establishing that community.
Yeah, for sure. Yeah, because people are always looking for more information on how to invest in those. Because as you said, it's kind of a small community. It's kind of nichey and a little opaque, but a very cool, very profitable industry once you kind of get in there and can kind of figure out what you're doing.
Yes, and one thing that happened is over the years um, I never really took on partners or anything like that. And I had over and over again people approaching me asking if they could work with me or partner with me in some way. And that was what inspired me to eventually launch a fund so
Mm-hmm.
that I could work with investors and have a partnership and doing it in the right way that is legal and within all the guidelines of the SEC. So that's been an exciting journey for me,
Right.
and I thoroughly enjoyed it. I find it very rewarding, and that those are some of the changes in the recent years that I've been through.
Mm-hmm. And is that fun for accredited investors? Or I know there are a million of the crowdfunding options now and different ways you can set those up.
Yeah, definitely. Crowdfunding has been a um, very popular form of offerings with a lot of media coverage about it when it first came out. We did look into that, but it wasn't really a good fit for the business. So we opted more with the traditional 506 offering and continued that way. What I find with crowdfunding, which are the Regulation A offerings, you have to have a very large capital raise
Mm-hmm.
in order for it to make sense because of the high overhead and high costs involved. There's a lot of compliance and overhead, and you have to use one of the approved crowdfunding portals to manage your investments. So there's
Mm-hmm.
some significant expense, and the numbers have to be very large, in the tens of millions, an offering of that size for the numbers to make sense to do it.
Yeah, I had looked at some of that briefly last year, and yeah, to your point, I mean, I think the attorney fees up front were significantly higher. I think some of those options, require audited financials, which is not a big deal other than it's expensive to get that done. So yeah, you need to have a much larger fund to get everything to work the way you want.
Mm-hmm.
But yeah, it's nice too when you have it just open to accredited investors too, because you can it's just easier to talk about. You don't have to worry about inadvertently, saying the wrong thing at the wrong time where it might be perceived as, soliciting investors you're not supposed to or something like that. So,
Correct.
yeah. So what's your primary focus in the fund? Is it more in the performing side or the non-performing side?
It's both, but we focus a lot on performing notes all across the country, and that's been a big focus of mine. Even prior to the fund, I found a lot of good opportunities to purchase notes that are in the performing space.
Mm-hmm.
And one thing I really like and what I find very powerful is doing those type of transactions out of self-directed retirement accounts,
Mm-hmm.
because it allows you to have a very powerful combination of the note investing, owning the note, and having it, since it's a performing note, it's really doesn't involve too much ongoing work or ongoing maintenance. So you have a hands-off transaction, which is ideal for staying in compliance with the self-directed IRA restrictions
Mm-hmm.
that don't allow you to do any physical work on the asset. You have a servicer taking care of the note for you, managing that, and the payments from the note go right back into your IRA directly.
Mm-hmm.
So you're not handling any of the funds. And the matter of that note investing, it generates a lot of tax liability for the investor.
Mm-hmm.
So when you can combine that with the tax preferential treatment in an IRA, or even better, if it's a Roth IRA, it becomes very powerful, because all of that income can go right back into your IRA and there's no tax liabilities incurred, which is fantastic. So that's something I really am a huge advocate for people. And what happens a lot, at least when I'm talking to folks, talking to investors, whether they're looking at investing in a note fund or individually into notes, I always ask them, are you doing this out of your self-directed IRA? And sometimes people will look at me and say, I don't know what you're talking about. What's a self-directed IRA?
Yeah,
And
most people not involved in real estate have never heard of those. Yeah.
yeah, so when that happens, we have to stop the discussion and have a different conversation right there. I said, look, we need to have a different conversation. I'm going to give you a little overview about self-directed IRAs and why you need to consider this in your overall investment activities, and see how you can work it into what you do, and educate them about that, because you can invest in notes, whether it's individual notes or in a fund, but you're going to be subject to taxes on all of that income, the cash flow coming from that. So if you can do it out of your self-directed IRA, that makes it so much better. And I find myself doing a good amount of education on self-directed IRAs, how to set them up, how to leverage them, how to move prior 401k accounts from the previous employer that you were at,
Mm-hmm.
and be able to utilize that for note investing and other alternative investments. A lot of people just don't know the possibilities about that. So it's really great to teach folks about that. And one thing in the last couple of years that has really come to the forefront is health savings accounts, and the fact
Yeah.
that you can use health savings accounts They are a tax deduction when you put the money in. There's no tax on the growth at all. And then when you withdraw the money, provided that it's for reimbursement of health expenses, there's no taxes due. So that is a triple tax benefit that you get. It's almost like the benefits of a traditional IRA because you don't pay tax on your contribution, and the
Mm-hmm.
Roth IRA because you don't pay taxes on the growth in the account. So you
Yeah,
really get
when you take the money out.
triple tax benefit off of this one vehicle. And the best part of it is you can self-direct your HSAs, just like you self-direct your IRA.
Mm-hmm.
Any of the custodians will be able to handle that for you. The self-directed custodians all offer HSAs, and it can be very powerful because when you start your growth in that account over long haul, you can have significant snowball effect because nothing's subject to taxes in there.
Yeah, that's nice to get, saving the taxes basically on both ends
Both
as opposed
ends.
to one or the other. So,
Yeah.
and then where do you stand on like checkbook self-directed IRAs? That's one thing that comes up sometimes that's kind of controversial. I've never used one myself, but I get people ask me about them a lot. So,
Yeah, they exist. Absolutely. I don't like them personally. And the reason I don't like them is I don't ever want to have to go through the ordeal of defending my account or having it get scrutinized. I think having a checkbook IRA opens yourself up to a lot of scrutiny from the IRS, and I just don't
mhm.
want to deal with that. Um,
Yeah,
because
I've been
you
on the
can,
same page. I've got just a regular self-directed IRA at Quest,
Mhm.
and I've never been the master of self-directed IRAs. Like I know enough about them to probably be dangerous. So I kind of like having them being the screen for everything. So, if I go and inadvertently try to do something you're not supposed to, I've got them, in the way to stop me. And, usually, I can get stuff funded within a couple days. I've never been in like that big a hurry. People like it because they can, just write a check and fund immediately. But that has never, for me personally, that's never really been an issue. It's usually a few days of processing time or whatever. And I can set things up so that works. It's not really a big deal.
Yeah, Dan, I totally agree with you on that. I've never had a problem where I needed so much speed that required um, writing a check outright. Um, Custodians, if you have a good relationship with them, if you need to get a deal done quickly, you just make a couple of phone calls and ask and explain to them the situation, and they will be able to process it for you quickly if you need it. So I've never had a problem with it, and I agree. I mean, they're providing a function of keeping your account in compliance with all the
Mhm.
rules, and I like that. I like that. I think that's a significant benefit. So for myself, I don't use the checkbook arrangement at all, but I know a lot of people that do, and they're okay with it. It works. It works for them. It's just something you have to assess how much risk you want to take or how much you want to expose yourself, because in reality it's just like the your tax return and the IRS. Yes, you can be aggressive with how much deductions you want to take and things like that, but you have to be ready to defend yourself in an audit if you needed to. And how much are you willing to uh, press that, and how aggressive do you want to be, and how aggressive is your CPA uh, with doing that, because ultimately they're the ones you're going to look to represent you in an audit.
Yeah, I kind of like having my IRA sort of out of sight, out of mind. I've just got some, I've got my old IRA that has, just mutual funds and things in it. And then my self-directed one, I just have some performing notes that just kind of sit there. And that way I can put all of my brain power towards my normal business and other things in life. Like I've always had the feeling like with checkbooks, they're probably fine if you really know what you're doing with them. But I've never wanted to devote the time to get to that comfort level. I just let my custodian kind of handle that for me. That's their job. So.
Yeah, no, absolutely. And even if you are doing everything fine, you're exposing yourself to scrutiny, additional scrutiny that you might still have to defend in an audit, your IRA getting looked at. And even if you are doing everything fine, you're looking at a significant drain on your time and expenses that you will have to pay for representation, even if you've done nothing wrong. In the end, you could be found that everything's good, nothing wrong, but you just spent all of this time and energy and expense in defending yourself in an audit. So I just prefer not to expose myself to that.
No, I get it. And so maybe, going back to the note funds a little bit. So like what kind of things, note funds are fairly popular. And I know I get asked about them a lot. What kind of things should investors be looking for, if they're going to evaluate some of the various note funds that are out there?
Yeah, there's a couple things that are really important. What comes to mind is the track record of the fund operators and the principals of the fund, which really is one of the most important aspects. And I think that investors don't spend enough time looking into that, because it doesn't matter what kind of a fund it is and what assets are being looked at. You have to trust the principles of the fund manager and the team. You want to look at their track record and consider that you're entering into a long-term relationship with them, and determine if you're going to be happy working with them or not. What is their track record? How long has the fund been in operation? Have they established themselves in the business that they're in or the industry that they're in? All of these things, I think that you need to do a good amount of due diligence on the individuals themselves, which includes running a background check, which includes Google search on the people, on the company you're dealing with. I'm finding it amazing to hear horror stories of people that got into a business relationship or an investment where if they would have done just 15 minutes of Google searching, they would have found a lot of negative information that would have changed their decision prior to getting involved, right? It's something that's so simple, and that's just to scratch the surface. I mean, absolutely, you should be running background checks on people to see are there any prior lawsuits, prior issues, all of those things that will come up. I think that's so important. And then once you do that, then yes, you can look at the fund's characteristics, what's their investment thesis and business model, and make sure that's in alignment with your risk tolerance and what your objectives are, right? Some people have an objective where they want steady income and cash flow, and you want to make sure the fund is set up for that. It would not be a good fit if the fund was a fund that doesn't pay any cash flow and it's strictly growth where all the payments are going to be on the back end of the fund. So you want to look at that timing, make sure that there's a good fit from the investment perspective and what your individual goals and objectives are, right? For a fund investor, or for an investor that is investing out of a retirement account, they're relatively young and they may not be looking for immediate cash flow. They can defer it. till the end, well, that's fine. But sometimes you have someone that does need the cash flow to cover their living expenses. They're looking for that, and then a different type of fund will be more appropriate for them. But
Yeah,
in
I know when I
summary,
was, or go ahead,
yeah,
sorry.
no, in summary, I mean, the main points: look at the fund operator and vet them thoroughly. And if you need help with that, engage someone to help you with it that is familiar with this, because it's one of the most important things. And like I said, there's horror stories that we hear about, and a lot of them could have been avoided if the investor did their homework up front before they got involved.
Yeah, it's amazing how many bad actors are running around out there. I know when I started in the business, I was probably a little bit naive about that because, as we talked about, right, it's kind of a small industry for the most part. People tend to know each other, so you would think all the bad actors would get kind of scrubbed out fairly quickly, but they do lurk around here and there. So it's, yeah, definitely need to check folks out before you invest with them. So
Yeah, it's really there's something analogy I heard that the way to approach this is you have to consider that you're betting on the jockey more than you're betting on the horse, and it's so true. Your evaluation of the principles of the fund and who's the operator of it is so important, even more so than what the asset is or what the business is. Yes, both are important, but you need to consider that level of priority, absolutely. And this goes for any type of private investment, whether it's a real estate syndication, apartment buildings, anything like that, or a commercial syndication. You want to focus a lot on the principles and fund and operators of that deal to make sure that you have someone with experience, competency, and ethics, and a good reputation. It's so important. I can't stress that enough.
yeah, because I mean, especially with like the non-performing side of notes day to day, it's a hard business to run, and you start getting a lot of them. I mean, it's really a lot of work. So you got to make sure you're going to have somebody in there that, you know, does what they say they're going to do and really follows through. So
Absolutely. And what I find is that when you have a good match and a good fit between investor and fund principals, that relationship will extend far beyond the life of the fund, far
mhm.
beyond that investment. And you will build a long-term relationship where the investment ends, all the capital is returned, everything is finalized, and the investor wants to reinvest their capital again. Well, where are they going to go? Obviously, they're going to go back to the folks that they had a good experience with, they had a good relationship with. It's just like any other business relationship. When you do business with others and it goes well, the next time you have a need, you're going to go back to the folks that you have a relationship with.
Yeah.
So I see it as a long-term relationship. Absolutely.
Yeah. And it seems like the successful fund managers, they tend to do, as you said, fund after fund after fund as time goes by. And a lot of those are with the same investors where they're just rolling
Yes.
over time as they go. So very cool. So I think of what else I was going to ask you, but so we talk about a little bit, you know, you said you were focusing a little bit more on the performing side of notes. You know, what are some things that, you know, new note investors should be looking at when they're considering buying a performing note and trying to analyze them to figure out if something's a good deal or not?
Yeah, there's a number of considerations. First of all, for the investor, they need to establish what kind of return they're looking for, as well as what is their risk tolerance. What
Hmm.
level of risk are they comfortable with? And sometimes for a new investor, they don't know. They don't really know. So they'll start looking at different deals, and that's totally fine, because you have to go through an iterative process to arrive at something that is going to work for you. And
Mhm.
maybe when you're starting out, you'll want to look at safer deals in return for a lower rate of return until you get comfortable. And that's totally understandable, totally acceptable. I recommend for newer investors, if they want to buy into a note directly, a way to do that is to buy a partial.
Mhm.
And why is that? There's a few reasons. The one thing is that on a partial, you're in a sense, you're partnering up with the seller of the partial who's owning the back end of that note, right? Just for the benefit of everyone, a partial is where uh, a note is taken. Let's say there's a 20-year note, it has 20 years of payments, and a partial can be sold where 5 years of those payments can be sold off, carved off the note, and sold off to another investor. So the buyer of that partial owns 5 years of payments and has the right to receive them. And then the partial seller still retains the back end of that, the remaining 15 years of payments.
Mhm.
And so the partial buyer who may be less experienced and not still be learning about the note industry, they're going to rely on the expertise of the person that sold them that partial to help manage the note, deal with any hiccups that might come up, and so on. And the owner of the note has a vested interest in making sure everything goes smoothly for the life of that note. So you have that partnership, in a sense, it's a loose partnership for those 5 years until year five comes at the end of year five, and then payments revert back to the note holder. So that's certainly one area I recommend. But other things to consider on a performing note is certainly the condition of the property, very important to look at that, and the borrower and their track record, right? Look at
Mhm.
payment history, what's the track record of the borrower and their credit history and character. Um, you look at the collateral, which is the property condition. What does that look like? It's very easy to obtain reports and have someone go out, look at the property. If you need to, take some exterior photos. Uh, Certainly a lot of online tools like Google and other mapping services that you can do a satellite view and drill down onto a property, and you can look at whether the exterior is maintained and the grass is cut regularly, or is a property where the grass is 14 inches high and there's 8 junk cars parked out on the front lawn of the house.
Yeah.
You can look at all those things. Or if the house is located in an extremely rural and isolated area, or is it in a suburban subdivision that looks very nice and has a lot of curb appeal. And you can look online at go on realtor.com or any of the sale sites, Zillow, look at houses for sale in the vicinity. Sometimes the house where the note is was listed for sale recently, and you can see interior photos of the house because they stay there on
Yeah.
Zillow.com or realtor.com. There's so much information available to us at our fingertips. And this is not even getting into any of the information that the seller of the note has provided to you yet about looking at the loan documents, and certainly all of those things are important. But that level of due diligence is key and critical. You want to dig in to that information. There's so much available. You can look at what people have posted online. People have blogs, people have social media accounts. You can look at all of that and get a sense for what you could be potentially getting yourself into and who are the people you'll be dealing with.
Yeah, there's definitely a lot you can look at and notes. And as you said, it's nice that you can do a big part of it just online.
Yes.
You know.
And I often will look at that as a first pass before I start digging into the loan documents and those type of things, because the loan documents, they're pretty standard. We buy a lot of institutional originated notes, so they're usually using standard Fannie and Freddie forms. So the loan documents are very similar, and I would say that's not a first pass look. I would look at so many other parameters first before delving into that level. The ones that make the first cut, then you can go down and dig deeper, do a deeper dive when you're looking at loan documents and legal aspects at that point.
Yeah, for sure. Usually I'm not digging into that stuff unless I've already bid on it and it's been accepted. But yeah, prior to that, I'm looking at more of the information that's readily available. So one of the things I'll do too is when I look at the Google images, like you said, sometimes you see those junked cars and other things that cause me to pass. But I'll look at when the Google photo was taken to see if it was the same borrower, because sometimes those Google Maps photos are a few years old. If I see a lot of junk and it's the same borrower, well, then it's probably still like that. But sometimes I see them where the picture is 6 or 7 years old and it was somebody else in there. And I'm like, well, okay, I can maybe proceed with this one for now and then get eyes on it.
Yeah,
later. Maybe some of that stuff's been cleaned up,
absolutely. And you can look at the neighboring houses as well to get a feel for the neighborhood.
Yeah, looking down, zooming down the street is never a bad idea. Yeah, because sometimes you'll see ones that are like boarded up, 2 houses away, which is not a great sign. Cool. Well, thanks, Brett. I think that's probably a good stopping point for now. We'd definitely like to have you on again at some point in the future.
Thank you.
Yeah, maybe let folks know how to. I'll put some links in the show notes, but how can folks get a hold of you if they want to talk to you more afterwards?
Yeah, absolutely. They can visit my website, which is fredmoskowitz.com. And another way, if anyone is interested to sign up for my free newsletter, which is about note investing and other investing topics as well, if they text the word note, NOTE, to 555-888 and follow the prompts, you can sign up for the newsletter and interact with me that way. And anyone that's interested in connecting with me, I'd love to hear from you, and always enjoy connecting with other investors and talking about note investing.
Cool. Well, thanks again, Fred. And I'll put all that information on the show notes. So I'll see you guys next time.